I'm Nikki Jovicic from LookUpStrata, and I'm also Managing Director of Tower Body Corporate, a body corporate management company on the Gold Coast. Today we're joined by Tyrone Shandiman from Strata Insurance Solutions to discuss increases in insurance premiums and excesses. Tyrone will talk us through the reasoning behind the increases and provide some considerations for committees in hardening markets. We'll discuss the factors impacting strata insurance premiums this year, including major claims, rising building costs, an increase in severe weather-related events, and building defects. Is there a happy ending, even though all indications suggest we're in for another bumpy ride through 2023? Tyrone will share some tips on ways to cope in these conditions. Today's session is a national session. If any information mentioned relates specifically to one state, we will mention that. Otherwise, the information will be national. And during the second half of the session, we'll join you for our regular discussion and Q&As. Before we begin, we'd like to mention that the information contained in the session, including discussions that arise from submitted questions and also during the chat conversations, is not legal advice and should not be relied upon as legal advice. You should seek independent advice before acting on the information contained in today's session. Tyrone Shandiman from Strata Insurance Solutions is back with us today. Now, Tyrone's sessions must be good because he always presents to really large audiences, so we keep on asking him back to join us and share his information. Tyrone is the founder and managing director of Strata Insurance Solutions and CoverRight Insurance. With a diploma in insurance broking, a diploma in financial planning, and over 15 years of experience in the financial services industry, Tyrone has risen to be an industry leader in the world of strata insurance. Strata Insurance Solutions has grown to service over 600 clients nationally, covering both residential and commercial properties of all sizes. As an authorised representative of Insurance Advisor NAT, they focus on building long-term relationships with clients while keeping in line with Insurance Advisor NAT's key values and principles of advice, value, trust and choice. Tyrone is also the chairperson of Australian Consumers Insurance Lobby, which is an advocacy group for consumers on issues associated with insurance. So that's a very important group. And Tyrone and the team at Strata Insurance Solutions have been long-time contributors and supporters of LookUpStrata. Tyrone has been answering audiences' interesting strata insurance questions for many years. And this is the 5th time Tyrone has joined us for a webinar. At the beginning of 2022, Tyrone joined us for a webinar, which you may have attended or watched, dealing with water damage claims. And that video has had well over 1,000 views on our YouTube channel. And there've been many more great sessions, all centered around strata insurance. So I'm very, very happy to welcome you back, Tyrone, to the session today. Thanks so much for being here.
Thanks, Nikki. It's great to be here. Thank you. Okay, thank you very much. So I'm here today to talk about the insurance outlook for 2023. And there's 3 main topics that I wanted to talk about in today's presentation. They are premium outlook, excesses and defects. And Nikki, thanks for the disclaimer at the start of the presentation, which is also shown on the screens there as well. Okay, so I know one of your listeners, Nikki, has asked what is the difference between a hard and soft insurance market and cycle. And I thought I'd start by talking about the insurance cycle, which typically will go in a 7-year cycle of hard and a soft market. And the best way to explain it is that in a hardening market, premiums increase because insurers need to maintain a certain level of profitability. And they reach a point where the premiums become very profitable for insurers. Insurers fight for market share, and to do that, they reduce their premiums and they go down to a point where they're not so profitable, and there kicks off the cycle. Now, it is typically every 7 years. This cycle, it's taken a little bit longer to reach the very top. And I'm going to explain the reasons for that. Now, if you look at global reinsurance markets, which is another factor that drives premiums, you can invest in global reinsurers, not by buying shares, but by putting capital into those companies. So just say, for example, you invest $1 million into a global reinsurer. They collect premiums for certain coverage. And if the premiums collected do not are not sufficient, they will take from your capital to cover those claims. And if they are sufficient, they will give you a dividend or a refund on those premiums. And when premiums are high, more people invest in the insurance market, creating more capacity to insure more. And when premiums are lower, people pull out of the market, and it means insurers have less capacity to insure you. So it's a supply and demand approach. Other things that will affect premiums are major claims like big storms. But I'm going to talk to you today about where we are in the cycle of strata insurance. And I kind of would like to just start by saying we're in a perfect storm condition at the moment. And I feel like after the last 3 years, I thought that the market would turn probably a year ago or 2 years ago, but it has still continued to rise. And there are a number of factors that have led into this, which I'll go into in more detail. So the first one is that we are in a La Niña weather pattern for the 3rd year in a row. We've had 3 straight years of La Niña. And La Niña, essentially, with La Niña, you see more severe weather events, but you also see more of weather events as well. So, and I'll talk about the severe weather events in a second, but what we're seeing reported from insurers in their annual reports is that not only are they seeing severe events, but they're seeing more events that are less severe as well. And insurers buy reinsurance on global markets for catastrophe events. Those policies have an excess on them. And if it's below the excess, the insurer covers the event 100%. And insurers have had a number of events over the last 3 years that have been small events where they've covered the event in 100% of that claim. The next one, we have had the largest natural disaster on Australian record for insurance, costing 5.7 billion. It was the March-February floods and storms. If you were in Brisbane, the word rain bomb would be familiar to you. There were 237,000 claims that resulted from that, making it the largest event in history just last year. Not only are we getting more events and larger events, but you see often on social media photos like this saying that the price of timber has increased by 50 to 100%. And we know that building costs are increasing, or material costs are increasing, for 2 reasons. Firstly, COVID did interrupt the manufacturing in China. Now that's starting to ramp back up now. But secondly, as well, the war in Ukraine is increasing the cost of raw materials as well. And that is flowing into an increased cost of building materials. So not only are insurers getting more claims, but what it would have cost them a few years ago is costing them a lot more now to repair and rebuild. And this all just flows into the cost of reinsurance. Now, as I mentioned earlier, insurers buy reinsurance policies on global markets to cover major losses and major catastrophic events. That cost base makes up about 30 to 40% of the insurer's expenses, and it is the largest cost base for insurers. Now, I was watching or reading an article on Reinsurance News on LinkedIn, and what we've been told by reinsurance brokers is that for catastrophe insurance globally, reinsurers are getting about a 27% uplift in their January renewals for reinsurance. So your largest cost base is increasing by 20%. And the last thing, I don't hear a lot of insurers talk about this, but it's just something I notice as a broker when I see claims come in, and that is that they just don't build properties like they used to. Now, in the early 2000s, a lot of the building products, particularly things like flexi hoses, which were manufactured locally, were manufactured in a quality process. What happened when builders started importing products from overseas, the quality of those products was just not the same. And we're starting to see the flow-on effect of that years down the track, that these pipes and these membranes and roofs are starting to fail a lot sooner than what they were expected to fail when products were manufactured locally as well. So what is the outlook for premiums and excesses? I'm telling my clients right now to budget for increases of between 20 to 30%. I was speaking to the CEO yesterday of the largest strata insurer in Australia. She told me that their average increase is about 18% average. Now, my philosophy with budgeting and when I talk to clients is that you're always better over budgeting than under budgeting, because if you over budget, it means you've got a surplus at the end. If you under budget, you may need to collect more levies to cover that. So I'm suggesting a budget of between 20 to 30%. Some of our clients are getting 7 to 10% increases, but we are seeing many clients getting increases between 20 to 30%. Now, unfortunately, we're also seeing excesses increase it from the standard $1,000 excess to $2,000. A number of the insurers, including the largest insurers, have increased the excess to $2,000 or indicated that they are increasing their standard excess to $2,000. For me personally, I feel that that is a real heavy burden for consumers and for policyholders. There are some insurers that have committed to maintaining the $1,000 excess. And I'm hoping that those insurers, that some of the clients vote with their feet and move over to those insurers, and the insurers that have increased the excess to 2,000 might say, okay, it's not feasible for us to do that. And I really feel the increase to 2,000 from 500 to 1,000, not so bad, but 1,000 to 2,000, that's a very, very big increase in my view. And I hope that it does come down when the market does start to soften. So what to do in a hardening market? I mentioned earlier, budget for the worst case scenario. Don't budget for a best case scenario, budget for an increase. It is likely you will get one this year. The next thing to do is to prevent claims. Now, claims is either the number 1, 2, or 3 rating factor in a strata policy, depending on the level of claims you have. If you can have less than 30% of so claims below 30% of your premium, insurers over a 5-year period, insurers are happy with that. All right. But prevention is the best cure. And we did a webinar with LookUpStrata on water damage claims previously. That for me is your number one way that you can impact claims and impact your claims history, is following the recommendations in that webinar. And the last thing is rebuild valuation. So I recommend in this market, because the sum insureds are increasing significantly, for large buildings, it may be advisable to get a rebuild valuation every 3 years instead of the 5 years prescribed in law for states like Queensland and Victoria, to ensure that you're not underinsuring your building or that you don't have a massive jump in your sum insured as well. If you're a smaller building, I still recommend stick to the 5-year valuation frequency. Okay, so the last thing I wanted to talk about in today's presentation is defects. And the reason being is this is a very, very topical issue in insurance right now. Things have changed over the last year and defects are becoming hard to insure. Why is that? I have 2 case studies which demonstrate why insurers are becoming less willing to insure buildings that have got known defects. The first one, Surfside Condominium in Miami, USA. This happened in June 2021. This was a really, really unfortunate event. The committee were advised in 2018 in an inspection that there were structural issues with the building. They got it re-inspected in April 2021, and sadly, only 2 months later, the building partially collapsed, killing 98 people and injuring 11 people. Now, beyond the property damage claim, there were significant claims for legal liability against the owner's corporation, against the contractors that were inspecting the building, against the security company, and against a number of other companies involved in this building. And the legal settlement entered into in the end was $1 billion. And that was only recently signed off by a judge. Insurers are saying buildings with defects, this is a worst case scenario of what can happen if we insure buildings that have got defects. So what insurers are now saying is, well, defective buildings make up, or we're seeing a lot of insurers saying, defective buildings make up such a small portion of the business we insure that we're getting to a point where we just don't want to insure them anymore. Where 2 years ago, before this event, they might have said, look, it's palatable for us. This demonstrates to insurers a worst case scenario of what can happen when they insure buildings with defects. Okay, I might just jump to the next slide. Sorry, the next event that we did see was the Grenfell Tower event in London, which is a very well-known event that occurred in 2017. And this was an event where 72 people died because a building burnt down with defective cladding on the exterior of the building. Now, the final settlement is not known in this claim, but that was a £20 billion building damage claim. And really what this now has demonstrated to insurers, particularly because all of the states around Australia have required inspections of buildings with cladding and reports and so on, is that strata buildings are now aware that they have defective cladding, and it's not excusable to say that we didn't know that it was there, like in the Grenfell Tower building. Now, unfortunately for clients in some states, like where I'm from in Queensland, strata buildings and committees are still waiting for the government to release some sort of package to assist them with removal of cladding. Now, in other states, what they've done is they've given interest-free loans. And the conversations I'm having to have with clients right now is, what is the cost of having an interest-free loan versus not having insurance? Or having insurance where the cost of that insurance probably outweighs the cost of the interest-free loan that you would get from the government anyway. And I guess that I've had to convince a few of my clients to really consider taking out a loan or raising levies to remove or remediate the cladding in their building, as opposed to waiting. And that's a conversation that a few of my clients have had, and they've taken the action of saying, we're not going to wait for the government. But the position that insurers are moving to over the last year is to say, we don't want buildings with defective cladding anymore. You've had enough time to take action and to fix them. Okay, so what are common defects? I'm not going to read this slide word for word, but the most common defect that we see in buildings are leaks. They're things like failed waterproofing and roof leaks. We also see from time to time structural issues, including issues with your building foundations. And the last thing I wanted to talk about is just building damage, including unrectified damage from insurance claims. I've got a client at the moment who had a claim denied for one particular lot because it was a maintenance issue that had occurred over a long period of time. That lot owner hasn't remediated or fixed that issue, and we are finding that no insurer wants to take on insurance for that building. So it is rendering them uninsurable. But essentially, unrectified building damage is another issue that we're seeing with some of our clients as well. Okay, so I just want to go through some of the reasons that we're getting from clients for not acting or not acting sooner. And I wanted to kind of share with you what the insurer's view of these reasons. So firstly, lack of funds. Now, this is a reasonable issue that you might have if you're a building that's just been notified of a defect or know an issue. Insurers' views are that lack of funds aren't going to get them off the hook if there's a major claim. And what they want to see is either raising of special levies or loans in some instances where it's reasonable to do so, as opposed to simply saying we don't have the funds. So lack of funds, insurers are really saying, well, that's not a good enough reason to not fix something that you're aware of. Waiting for AGMs. Again, this is another delay that insurers aren't really accepting at the moment, because their view is you can always call an EGM at any time. Can't find a builder or contractor, very prevalent issue during COVID. And also during the last year, because of the major storms that we had and major events, starting to become less of an issue right now. But what insurers want to see, if you can't find a builder or contractor, is they want to see what you've done to find a builder or contractor. If you've only message to builders and haven't really received a response, that's probably not a good enough reason to say we can't find someone. They want to see you be more proactive and take more and show that you're taking more reasonable actions to find someone. Finally, the last one, which is a really difficult one for us, for the insurers and for clients, is for buildings that are pursuing a warranty claim against a builder. Sometimes when you're pursuing a warranty claim, the builder doesn't respond and doesn't fix the issue, and you have to take them a tribunal of some sort, and that can take a lot of time. And in those instances, what we want to show the insurer is, look, we're doing everything possible to pursue that warranty claim, and it can take some time, and we really have to kind of get the right message to insurers when we have those issues come up with our buildings. So I wanted to talk to you about how to avoid being uninsurable if you have defects or known issues in your building. The first thing is to speak to us as soon as you become aware of those issues. And the reason being is that we can tell you what you need to do to become as insurable as possible before we need to disclose those issues and defects to your insurer. The second thing, if it's possible, is to repair those defects as soon as you possibly can. Thirdly, have a clear and reasonable plan in place for rectifying the issue. What does that mean? We want to be able to demonstrate is that by this date, we want to have the defects rectified, and these are the steps that we're going to take in the interim period. Or if it's if it's something that you've just recently been notified, you might just show this is our plan to get to the final point. And the reason why you want to do those two things is that when your policy comes due for renewal, if you haven't made a change in the period of insurance, that's the point at which you need to notify the insurer of the defects or issues. So if you've rectified them before the policy expires, or you have a very clear plan, then your insurability, obviously, in your prospects of insurability increases significantly. The fourth point I wanted to make, and I see this with a lot of buildings, buildings that are newly built have a defects warranty period. And what buildings will do is they'll carry out a defects inspection before that period expires. Now, if there's no known issues in your building, the best time to carry out a defects inspection is in the weeks and months after your policy has expired, not in the weeks and months before your policy has expired. And the reason why is that you need to notify your insurer at renewal of any known issues, including defects reports. If the report is provided to you in the weeks after the policy expiry, you have the whole year to get everything in order before you need to notify the insurer. Don't bury your head in the sand is the next point. I get a lot of committees where defects and building issues are just too hard. The problem with that is that the consequence of doing nothing could possibly mean more work and more heartache for you and the owners than if you had just acted when you were made aware of them. And finally, prevention is the best cure. Maintenance of your building will ensure that you have less defects in the future, and a well-maintained building will have less of these issues and have less issues with insurability down the track. So I wanted to end on a positive note. Will the market turn? Now, today's presentation has probably highlighted that we're in hard markets and the defects are becoming hard to insure. But I do believe that premiums having gone up by about 50% over the last 3 years, we're starting to reach a point. There has to be a top point in which premiums become profitable for insurers. And I feel that we're getting to that point very shortly. If we can go through a couple of cycles or a couple of years without La Niña, if manufacturing ramps up in Asia, if the war in Ukraine changes, and the fact that interest rates are rising, so insurers are earning a lot more on the billions of dollars they have to put into reserves, what we might start to see is more profitability in insurers and the markets start to turn. So I feel that we're reaching that point. I felt that 2 years ago, but I feel now after 2 more years of rises, there has to come a point at which the premiums reach the top. And I feel that possibly we are there. So it's not all doom and gloom. And markets do go in cycles. And I will say that in 2016 and 2017, a lot of our clients got reductions of more of 20%. And I feel that we may be starting to see the top point of the market being reached. So thank you very much for giving me the opportunity to present today, Nikki. That's all I had to share, but I know that you've got a lot of questions, so I think it's now a good opportunity to answer those on behalf of your listeners.
We've had some questions come through, as always, to us, so we might start with those. So we had one that came in, Tyrone from WA. Can the amount of declined claims against the strata scheme policy increase the premiums payable? And is a broker obliged to advise the insurance company if they're aware of failure on the part of the strata company to maintain the common property in good serviceable order?
Yeah, so let's start with question one. So insurers will look at a claims history and they will look at the claims in detail. Now, when they look at the decline claims, they want to look at a couple of things. What is the claim and why was it declined? Is it declined because it's a known maintenance issue that you didn't rectify and it's caused damage to your property and that maintenance issue still remains? Was it declined because it was simply below the excess? So decline claims will be considered by insurers, not always penalised, but they will definitely be reviewed and considered by insurers when they look at claims. And it really depends on what the claim is, why they declined, and whether that particular issue could pose a risk of future claims for future policies as well. In regards to lack of maintenance, insurers aren't. It depends on what that maintenance issue is that you're talking about. If it's just that someone hasn't maintained a garden or something like that, that's not an insurance issue that needs to be disclosed to insurers. When you need to disclose to insurers, it's at the point at which you believe that that particular action of not maintaining will increase the risk for the insurer. That's the threshold under the Insurance Contracts Act.
Okay, thanks, Tyrone. Could you please give us your views on the dangers of underinsurance, which is particularly relevant in the current climate where real valuations are rapidly skyrocketing? So I thought that might be a good point to make.
Yeah, absolutely. So there's a couple of dangers with underinsurance. So first and foremost, you must insure by law your building for full replacement value in every state and territory in Australia. Failing to do so can result in fines and penalties for the body corporate. That's the starting point. The worst case scenario, and I've actually seen this before, of a building that didn't get the valuations every 5 years by law and was underinsured, and it was a total loss. Now, in the event of a total loss, if you underinsure your building, then unfortunately the body corporate or owner's corporation has to make up the losses for that claim. So the danger of underinsuring is that you will have a major or total loss and not be covered. Now, the one good thing with strata policies, which is different to most other property policies, they don't have an underinsurance clause. Now, in other property policies, they have a clause that says if your insurance value is 80% or below what it should be, we'll only pay a portion of that claim if it's a partial loss. In strata insurance, because you're required to insure for full replacement value, they don't have that clause, which is good, I guess, one of the good things with strata insurance policies.
Okay, so we've got New South Wales and Queensland. Between an in-house insurance department versus insurance broker, who is likely to get a more competitive quote? And if using an insurance broker, is there a benefit in using more than one broker?
Yeah, absolutely. I think it really depends on who you go to. It really does. So, look, I will say in-house insurance departments in a strata management company can be very useful, particularly for committees that want a very hands-off approach to managing their strata insurance. Sometimes, I guess really what's going to differentiate brokers to brokers is who do they go to? Are they going to the whole market? Which insurers are they going to? And the second thing is, what is their commission and fee structure? They're the two main things that are going to really differentiate the outcome for you. Look, it can be beneficial to go to more than one broker, but really only in circumstances where you haven't already gone to the whole market, and two, that it might be that the broker's fees and commissions are much higher than another broker. So what we'll typically do when a client has got a quote from their broker, we'll ask them the question, who has already quoted you? And also, if you have received quotes, and your holding insurer is the most competitive, we just want to know whether our fee for service structure is more competitive for you as well. So the answer to that question is that it can be, and sometimes it might be that who you're with is the best in market already.
Okay, thank you. How is insurance impacted by EV vehicles in an underground car park? Do you have any information on that at this point, Tyrone?
I do, yeah.
Something that people are talking about. We're seeing reports come out from different fire services around Australia in the different states.
Yeah, absolutely. Right now, EVs or electric vehicles are not impacting insurance, right? What's going to happen? It will be like, I see it as being the cladding issue, where when there's a major claim, insurers might start to act. All right. So right now, we don't have any direction from insurers around loading premiums for electric vehicles or special conditions. But that's not to say that that won't happen in the future. And I'm getting a lot of inquiries from people saying, look, we're looking at putting electric vehicle charging stations in our property. What is the impact? I say to them right now, no impact. But that's not to say that won't change if those electric vehicle stations or vehicles cause a number of claims for insurers. So I would recommend that committees approach that with a bit of caution. Even though it's not an impact right now, it may be in the future. And of course, if you have a major claim, that's going to affect your 5-year claims history, and that will result in higher premiums if there is a major claim from it.
I think in every session we've recorded with you, Tyrone, you always mention that relationship between the broker and you're always contacting your broker, keeping them informed all the time about what's happening, having conversations with them. So once again, if you do decide to install EV chargers, you're best to contact your broker at that point and let them know that you're going ahead with something like that.
Correct. Yes, absolutely. Definitely speak to them. And again, the common inquiry we're getting right now is, what is the consequence? And that's the most common inquiry that we're getting.
Okay, wonderful. Thank you. From Queensland, we were asked, most body corporates will now have their insurance premiums in the 5-figure range these days. This money is paid up front and the insurance companies effectively get an interest-free loan for the 12-month insurance period. Could these premiums be paid quarterly without penalty, thereby reducing the highest admin cost of our annual budget? This would remove the body corporate's requirement to carry a large balance in the admin fund for up to a year until the account is paid, and be attended to in as quarterly fees are paid.
Yeah, absolutely. I know that there are some insurers, not ones that we deal with, that do allow installments in their payments. But just keep in mind that one of the ways insurers, I guess, that they put the money into a fund and collect interest, and that's part of what they do to factor in your premium. So insurers aren't banks. So you can, in those instances where you haven't got enough money in your fund, in your admin fund, you can premium fund. But that does come at an interest charge to you. So what you'll find is that most insurers won't offer installments. And then if you do find someone that does, the question is, what's the cost benefit to you in insuring with that insurer versus someone else? So my advice is just ensure that you that's fully budgeted for and collected for in your levies.
Okay, thank you. And we always get asked this question, and we've been asked, I've been told there are only 5 companies that insure body corporate. So is this true? We get versions of that in all states around Australia saying that they can't find someone to insure, or there's only 1 or 2 companies that will actually offer insurance.
Yeah, correct. So it depends on the building. All right. It does very much depend on the building. There are some buildings where there's only 1 insurer. I've got clients that there is only 1 insurer because of the type of building or the size or so on. Look, from our perspective, there are, I think, 7 insurers we can deal with, but not all of those 7 insurers won't deal with every style of building. Like, for example, one of those insurers only deals with high-rise buildings, right? But we have 7. There's a few direct insurers that deal in the smaller market as well. But look, 5 seems like a reasonable number of insurers. There might be a few more if you go to other brokers and so on. But yes, it's about 5 to 7 insurers for most buildings.
Okay, and then we had a question come through, which is a national question. In view of the very large insurance income you control in respect to strata companies and the substantial increase in premiums and therefore commissions received, should you now consider writing this business on a flat fee basis and also look, when the time is right, to offer via insurers a 3 or 5 year long-term agreement?
Yeah, absolutely. So just a few things to unpack there. So we are fee for service. Our fees are linked to the premium though. There has to be a way that you charge. And for our company, when premiums go down, our fees do actually go down as well. We don't raise our fees if premiums go down. But look, there are brokers out there that may have a flat fee for service arrangement as well. I guess it's a case of just finding out who is the right broker for you to give you the right advice. And I guess looking at the fee and competition in the market as well. But look, I think that in certain cases, a flat fee is reasonable. Our company in Northern Australia and North Queensland particularly do not work on a fee linked to premium when someone is earning paying 20 times the amount for their premium than they are in other parts of Australia. So there are circumstances where a flat fee is reasonable that we view that. But I guess that you have to find a way to in some way to charge, and that's how we have traditionally done it over the years. So yeah,
there's quite a few people have been asking about whether they can nominate their own excess.
So you can, so some insurers are moving to minimum excess structures. So some are moving to 2,000. Some insurers are moving to 2,000 standard excess, but giving you the option to go to 1,000, but it's often not feasible from a premium perspective. But what we do when we submit quotes is we give you all of the options that are available and excess options as well. And you can decide based on the premium and the excesses what's best for you. And sometimes it's better for you to pay the higher to have the higher excess, because it might be that in paying in having a lower excess of $1,000, you're paying an extra $3,000 in premium, and that's just not feasible unless if you're having 4 or more claims each year. So yeah.
Okay, and we just had a comment come through saying poor maintenance plans and lower sensitivity to risk by insurers seems to be the greatest impact on the costs of insurance. Is that true?
Yeah, if your property isn't maintained well, you will see more claims impacting your claims history. Not only will it impact on the cost to insurers, but it will actually impact on the cost of your premiums as well. Because if you're having claims, as I said in earlier slides, claims is the first, second, or third rating factor when it comes to strata premiums. If you're having a lot of claims, it's the number 1 rating factor. So it will cost you if you're having more claims due to poor maintenance.
Okay. You put forward that premium increases will be in part due to increased building costs. My strata revalues its building every year based on indexes and a 5-year valuation cycle. If the premiums go up because of building cost increases, does that not mean that we will suffer because we keep our valuations up to date? It sounds like we'll be hit twice, once from an increase in our percentage premium and again because we've revalued the building.
Yeah, absolutely. Look, right now it is a bit of a double whammy effect. So the rate itself is increasing, and so is the cost of rebuilding. But on the flip side, remember the question was asked about what's the consequence of underinsuring. So you need to look at, is it worth paying that little bit more premium and being insured for the full replacement value? And I always would argue, yes, it is.
Okay, and we've also received a question saying, should the insurance renewal be due at the same time as the AGM?
Look, it's up to committees to determine when the renewal comes due. There's a number of factors. So the first one is your budget meetings. So some committees like to be able to budget on actual figures that they receive. Now that means that the renewal would be received before the AGM. The second one is that some committees like owners to vote on the insurance at the AGM. So it does come down to personal preference of committees. But yes, I guess there's no specific time in which a policy must be due, and it really is a preference for committees.
Okay, thank you. And then we had one from Queensland saying, I'm a lot owner and committee member for our standard format plan body corporate in Brisbane, containing 19 standing units and no buildings on common property. Last year, a couple of disgruntled owners opted out for our body corporate's voluntary insurance scheme as provided for in the BCCM legislation to take up their own building insurance. However, insurance companies insist they will only provide cover for the entire complex and with no premium reduction. The lot owners opting out don't expect they should be paying twice for building insurance, and it seems the remaining owners are left by default with the additional cost. Recent advice is that insurance companies are maintaining this position when we look at renewing the policy this year. Any advice to committees managing the consequences of decisions made by companies and lot owners where we have no influence, and there does not appear to be any options shopping around?
Yeah, unfortunately, this is an unfortunate situation. So I take it that's a Queensland question, is that right, Nikki? It is a Queensland question. So in Queensland, buildings that have shared walls and roofs must be insured by the body corporate. If there are standalone lots, they have the ability to opt out or not insure under the strata policy. Now, most insurers want to insure the whole all or nothing, and the reason being is that their policy is not written in a way that allows for insuring parts of the building and some parts and not others. So it does mean that unfortunately for some strata buildings that don't have the opt-out option, there's only one or two insurers that might offer cover under that circumstance. And what I would suggest in those circumstances is if they're all freestanding lots, which it sounds like in the question, you may need to dissolve the voluntary insurance scheme completely and have the owners insure their lots individually. And that's what the consequence might be. And I guess for the owners that did opt out, it's going to come down to them a decision on, was it worth staying in the voluntary scheme or was it worth getting my own insurance? And that's what each owner is going to need to consider. But in this case, I think you may need to consider dissolving that voluntary insurance scheme and just insuring the buildings that are, or the common property that is required to be insured by the legislation.
Okay. And to seek more advice on any of that, Tyrone, who are they best to contact? Is it a strata decision? Are they best to talk to a broker? Who should they be talking to?
I would always say speak to your broker. That's the advice that I would give if someone contacted me. But it might also be that you speak to the owners and try to encourage them to rejoin as well. There are a number of ways that you can approach this situation. But yes, the best thing would be to act on the advice of your broker and strata manager as well.
Okay, thank you. If you have a report advising of a known problem, however, the report states that no action is required for now, do you still have to advise the insurer?
Yes, so the threshold at which you need to advise an insurer of a report or a defect is when that issue increases the risk for the insurer. Okay, that's the threshold at which you need to notify the insurer. So even though the report might say no action is needed right now, it may still increase the risk for the insurer. Now, just keep in mind, if you've got reports that are on your body corporate records and there is a claim, the insurer can and has the right to go through your records. And I've seen this happen in claims where clients have had reports that were not disclosed, and an insurer has sought to decline a claim because that issue was not disclosed to them. So get advice from your broker as to whether it's something that needs to be disclosed. But again, the threshold is, does it increase the risk for the insurer?
Okay. And we've also been asked, how does an insurer determine the building is well maintained?
Look, insurers don't really look at whether a building is or isn't maintained. So what are the things that insurers will rate on? Firstly, they'll look at your claims history. All right, that's an indication of maintenance of your building. Secondly, disclosable reports that you provide. If there's issues of poor maintenance or maintenance required, they will be in those reports. But they don't. The insurers have a flat rate on the assumption that a building is well maintained, and they will use the other indicators to determine if it is not well maintained.
Okay, thank you. In New South Wales, do I need to update the valuation done on year one by CPI movements annually until it's next due for its 5-year valuation?
Yeah, so I'll say in New South Wales, there's no requirement to get a valuation every 5 years. That was repealed in the 2018 legislation, but we still recommend following the guide of a 5-year valuation for most buildings. I would be inclined as a committee member to increase by CPI at least for those years. The problem is if you don't, and in 5 years' time, you have an increase by 5%, you might find that you have a very interesting surprise 5 years later when you get a rebuild valuation done. Secondly, it's obviously implied that the cost of rebuilding increases every year, and the legislation imposes a burden on you to insure for full replacement value. So if you're not increasing by at least CPI or the insurer's indexation, you may risk not insuring in accordance with the legislation, or having a very large increase in 5 years' time when you get your building revalued. So it's our recommendation to increase by indexation.
Okay, we've also been asked, how do you improve your claims history? And I guess I had a question around that too, because you were mentioning about the standard excess increases to $2,000. Will that decrease the claims made on buildings, do you think?
Yeah, absolutely. So it will definitely decrease the number of claims, right? We have claims on under $1,000 excess where the payment is below 1,000. So it is going to decrease the number of claims. What I think it may also do is get owners motivated to do maintenance. When you've got a $2,000 excess, it might only cost you $200 to get a plumber in to check your flexi hoses, your membranes and showers and sinks and so on, and prevent you from having a claim in the first place. So so I think that would be one of the consequences that come from the higher excesses.
Okay, so when it comes to improving your claims history, do you have anything else to add to that, Tyrone?
Yeah, look, I think that maintenance of common property, inspections of the building, and the water damage webinar that we did are the three things that I would suggest in reducing claims. But notwithstanding, some claims just cannot be helped. A kitchen fire, there's nothing you can do to prevent that. You know, a lightning strike on a building, that's just, unforeseeable, and there's nothing you can do to prevent that.
Okay, thank you. Okay, Northern New South Wales. Why is our property being penalised for an increase in premiums to mitigate flood and fire claims when on the one hand we're not insured for flood and the risk assessment for fire is 0 to no risk for the amount we are insured for? Why are we being penalised with an increase in excess payments of 500%? So it's up from 500 to 2,500 per claim for other lesser aspects of the policy when the technology available to precisely locate any subterranean pipe issues reduces the risk claimed to the insurance company. Why should we even insure? I'm annoyed and angry that insurance companies and brokers are only interested in comparing our policy to return with a pittance of a reduction under the guise of being competitive, but with a reluctance or an ignorance to explain why the double barrel increases are occurring, other than to quote, "That's the way the insurance industry works." It's very frustrating.
Yeah, look, I understand the frustration as well. So thanks for the question. So the insurance market works on a global scale, and it does look at events not just in one specific area, but what's happening globally or what's happening around Australia. And when we have floods and bushfires and major events, that will increase the cost for policyholders not in those areas as well. $2,500 excess sounds to me like there has been some kind of a claim issue in the past, and that's probably what the owner is alluding to. Look, insurers will rate on the past claims history, and even though you might have, equipment that can find the pipes and subterranean infrastructure, the way that insurers rate is they look at, okay, what is your history over the last 5 years? And if you've had some claims, it might be that even though you can demonstrate that you have done what you can to mitigate the losses and prevent them from future, you have to ride the 5-year history out, and you might be subject to higher excesses as well.
Okay, so just on that, we've just been asked the claims history is forever, but you're saying it's a 5-year.
It's a 3 to 5. So some insurers will rate on 3 years, some will rate on 5. So yes, and that's one of the ways insurers will rate premiums. Yes.
Okay, excellent. All right, thank you. If for some strata schemes, none of the insurers like to insure, what is the way out? Is the voluntary insurance scheme the only way they can get insurance?
Yeah, this is a really interesting topic because I do have clients that have not got insurance at the moment. Look, it's really difficult for committees in this position because the legislation requires you to insure for full replacement value. In states like Queensland, if you can't insure for full replacement value, you need to have an alternate insurance arrangement in place. So what is the way out? I think that what you need to do as a starting point is demonstrate that you've done everything possible to insure the building. And I will say that there are buildings out there that are not insurable and that are facing issues where they can't find insurance. I think that in that instance, we need to work out why is it not insurable? What can you do as a committee to make it insurable? I mean, I've got a building at the moment, as I mentioned, where there's unrepaired damage and the committee is deciding whether they just go in and fix it or make the owner fix it or take legal action against the owner. So in those circumstances, it is really a case-by-case scenario and you need advice from your broker and strata manager on how to deal with that issue.
Okay, thank you so much, Tyrone.
Thank you, Nikki. Always a pleasure to present to you and your audience. Thank you.
Excellent. If you gained value from this video, please hit like and subscribe to our YouTube channel. If you're looking for information about parking, strata insurance, defects and more, head over to lookupstrata.com.au or sign up to our free weekly newsletter via the link in the description box below.